welcome to my channel, Learn and Earn, to live your life on your own terms. Hello everyone, you're welcome to my channel, Learn and Earn Academy. And today, in this video, we are going to learn about National Pension System. What is NPS and how this National Pension System is going to impact you no matter where you are employed. So let us learn about this important concept which we all, when we join an organization, a government organization or a private one, we will have to enroll ourselves in this system. So National Pension System is a pension system launched by Government of India with the following objectives: to provide old age income and security to the person who gets retired after 60 years of age. Now, the important concept to understand under national pension system is that this pension system is based on market performance of your investment. Now, the objective and the motive of NPS is to extend old age security coverage to all the citizens. So when we talk about NPS, the most important factor which we need to understand is all the contribution which you are making towards your pension is being invested in the market. And as per the market performance on that particular day on the day of your retirement, you will get the same return on the entire amount which you will invest for your whole life for a period of 60 years. Now, NPS is based on a PRAN number, which is called Permanent Retirement Account Number. Now, it's a card similar to a PAN card, which is allotted when you subscribe for NPS. Now, this is a card which will be with you, and this number which will never change and will be with you for your life till the day you retire. Now, it is the cheapest market-linked retirement plan. Now, when I say cheapest market-linked retirement plan, this means the amount of money which you're investing as a pension, or I would rather say the amount of money which is getting deducted from your salary, and the similar contribution of the same amount is made by your employer. Now, these two contributions will get invested in the market, and if it is getting invested in a market, there will be market players, there will be companies and financial institutions who will be handling your money, and these are called fund managers. Now, the beauty of NPS is under NPS, the fund managers will get the minimum commission. So the benefit if you enroll in NPS is you will get the maximum return on your investment. So excessively less payment of incentive commission to the intermediaries, and these intermediaries are the financial institutions who will manage your fund. So what is the commission which gets paid to them? Now, if you invest money under ULIP, which is another type of pension plan, you have to pay 1.35% commission to the financial institution, to the insurance company. If you invest in mutual funds, you need to pay 1.25% of commission, or maybe more than that. And under NPS, you only have to pay 0.25% of the commission. Now you can see this is the least commission which any pension plan at present in the country is charging. So the result is more benefit, more amount of money which you'll be getting at the end of your service tenure. Now, there are two types of NPS account. One is Tier 2 account and one is Tier 1 account. Now, Tier 1 account is your normal pension account in which your salary, deduction, and your employer contribution gets accumulated and invested in the market. Now, Tier 2 is a voluntary saving account in which you can put money as per your wish, whatever amount you have, and that amount will also get invested in the market. So it is similar to a mutual fund account or a saving bank account. You can take out your money anytime in Tier 2 account. However, in Tier 1 account, it will be a normal pension account and there will be limitations on withdrawal. So what are the types of funds in which NPS will invest your contribution? For example, from your salary, the government deducts 10,000 rupees. The same contribution will be made by your employer. So 10,000 from your employer. So in 1 month, 20,000 is getting invested in NPS. And this 20,000 every month will be invested in the market through mutual funds. And these are the three categories of funds in which your contribution will be invested. First is index-based stocks. Now these are completely equity-based stock. Now equity involves more risk. So it is entirely dependent on market. But obviously if it has more risk, it will give you more returns. The second category of funds in which your 20,000 will be invested is bonds issued by state governments, public sector units, and private firms. Now, these securities or these investments are more secure. So obviously you will get less return as compared to index-based stocks. And the third category of fund is the bonds issued by central government. Now these are the safest funds and hence you will get the least return. So your 20,000 per month will get invested through NPS in these three categories of fund: index based, bonds by state government, and bonds issued by central government. Now the exposure to equity, that is the index based stocks, the riskiest stock cannot be more than 50%, and this allocation is not specified, so it depends upon your age. For example, if you are young, let's suppose you are 25, you can take more risk. So in your allocation, 50% of the funds will be allocated to category E, which is index based stocks, and the remaining 50% will be invested in state government bonds and central government bonds. So this is the advantage. This is the benefit. So the more young you are, the more risk you can take and the more return you will get. And as soon as you get older, maybe 40 or 50, this proportion of investment in index based stocks will decrease. So from 50%, maybe 30% will get invested in equity, and the remaining 70% will get invested in safe funds, in state government bonds or in central government bonds. So your portfolio of allocation of your funds will depend upon the age, depend upon how much time you have for your retirement. So this is a brief overview of the distribution of the allocation of funds of your accumulated amount every month. So with increasing age of the investment, the corpus gets more inclined towards debt. Now, debt is a more safe form of investment, such as state government bonds and central government bonds. And equity is risky because it involves entirely market based. So, what are the positives and negatives of NPS? Now, the biggest advantage of NPS is it gives you tax benefit, which every salary salaried employee would love to get additional tax benefits. The fees to the intermediaries is less. That is the commission. Now, the biggest disadvantage of NPS is that the amount of fund which you will get at the time of retirement, only 60% of that fund you can withdraw, and the remaining 40% will be invested to give you pension till the time you are alive. So let's suppose at the day of your retirement, you have you have invested 100 crore rupees. So how much money you can withdraw on the day of your retirement? Only 60 lakhs. So what will happen to the remaining 40 lakhs? Now this 40 lakh will be invested again in the market, and this investment return you will get in the form of pension every month till the time you are alive or your dependent is alive. So your 40% of your contribution, of your own contribution, will buy you pension. So earlier government used to give pension, but now you are earning your own pension. This is the most important aspect of NPS. Now, there have been various debates, issues, and concerns raised by people to bring back the old form of pension system. And under proposed DTC, direct tax code, there is plan to exempt NPS funds from tax at withdrawal. So, however, it is uncertain if the direct tax code would allow tax exemptions on returns from annuity plans as well. So the tax at the withdrawal stands in the way of NPS making the best pension scheme. Now, can you imagine the amount of money which you will get at the day of your retirement, on the day of your retirement? You'll have to pay tax on that as well. This is another disadvantage. So the first disadvantage is you can only withdraw 60% of your accumulated wealth. And the second disadvantage is you have to pay tax on whatever amount you will get. Now, mandatory annuity limitation of withdrawal from Tier 1, that is the primary pension account. As I've already told you, there are two accounts, Tier 1 and Tier 2. In Tier 1 account, you will have limitations of withdrawal. So you cannot withdraw your pension funds anytime. No, there are certain limitations. You can go through those limitations later. And on maturity, as we have already discussed, only 60% of the funds can be withdrawn, and the remaining 40% will be invested to pay you pension every month. So normally interest rates depends upon the market. 12 to 14% of return if you are getting, it is huge. But if it is anywhere between 6 to 7%, it is normal, like a fixed deposit amount, which is again a reasonable amount. But to get 12 to 14% return is huge returns. It will almost double your money. So how to contribute towards NPS scheme? It is very easy. You need to just register for PRAN. It will be a 12 account permanent retirement account number. It is similar to a PAN card. This will be a unique identification number which will be with you for your whole life. It will be your pension account number. So I'm sure you like this video and you have a reasonable amount of knowledge about NPS. You can like this video. You can also share this on social media and subscribe to my channel. This will encourage me to make more videos on these type of topics. You can also comment below on any other topic on which you want me to make the next video. Thank you. Have a great day. Bye-bye. If you like my video, please like, share, comment and subscribe to my channel by pressing the bell icon.